Welcome to the Tellone Perspective. I am Dean Tellone, and this is a podcast where we talk about the things that matter: finance, real estate, education, and life. No gimmicks, no jargon, just practical insights from someone who has spent over 50 years working in financial services. In this first episode, I want to talk about something close to my heart. I want to share the key lessons I have learned over the course of a career that has spanned more than 5 decades in the financial services industry. We are going to cover how this industry has changed, what has stayed the same, and the principles that I believe are essential for anyone who wants to build a lasting career in this field. So let us get right into it. Most people do not realize how young the financial planning profession actually is. It was not until December 12th, 1969, that 13 individuals gathered in Chicago to discuss a better way of providing financial advice. That meeting led to the creation of the International Association for Financial Planning and the College for Financial Planning. It also led to the development of the Certified Financial Planner designation, the CFP, which is now held by nearly 86,000 professionals across the United States. So when I started my career, this profession was still in its early stages. There was no established playbook. There were no online courses. There was no YouTube to watch. You learned by doing, by listening, and by paying attention to the people around you. And that is actually the first lesson I want to share. Lesson number 1, be willing to learn from the ground up. No matter how much education you have, the real learning starts when you are in the field, sitting across from a client and trying to help them solve a real problem. A degree gives you the foundation. Experience gives you the judgment. Now let me take you back to the 1970s and 1980s, because this is when the financial world really started to shift. In the 1970s, inflation was rising fast, driven largely by oil price increases. People who had their money sitting in savings accounts were watching their purchasing power shrink. This pushed a lot of Americans to start thinking differently about their money. Between 1977 and 1981, investments in mutual funds went from $3.9 billion to $181.9 billion. That is an enormous shift in a very short period of time. Index funds were introduced during this period as well, giving everyday investors a way to participate in the broader market without having to pick individual stocks. And in 1974, the Employee Retirement Income Security Act, known as ERISA, was passed. This was a landmark piece of legislation because it imposed fiduciary duties on those managing retirement plans. It was one of the first times the law said clearly, if you are managing someone else's money, you have to act in their best interest. Then came the 1980s. The stock market was booming. In August of 1982, the Dow Jones rose 10% in just 1 week. Mortgage rates were above 18%. Credit card usage was going through the roof. And then, at the end of the decade, the savings and loans crisis hit. The industry had to be bailed out to the tune of $159 billion. Lesson number 2: markets go up and markets come down. The advisors who survive are the ones who plan for both. I have seen bull markets that made everyone feel like a genius, and I have seen downturns that tested every ounce of resolve. The key is to never get too comfortable in the good times and never panic in the bad times. Steady, disciplined planning is what gets clients through. The 1990s brought the internet, and that changed everything. Suddenly, clients could look up stock prices on their own. They could read financial news in real time. Online banking started to take hold. Financial services firms began merging into what people called financial supermarkets, one-stop shops where you could get banking, insurance, and investment services all under one roof. In 1998, Citicorp and Travelers Group merged in a $70 billion deal. And in 1999, the Glass-Steagall Act, which had separated commercial and investment banking since the Great Depression, was repealed. Then came the 2000s. First, the dot-com bubble burst. Then, in 2008, we experienced the worst financial crisis since the Great Depression. Millions of people lost their jobs. Millions lost their homes. Retirement accounts were devastated. The Dodd-Frank Act was passed in 2010 as a major regulatory overhaul to try to prevent something like that from happening again. Lesson number 3: technology is a tool, not a replacement for good advice. Today we have robo-advisors, artificial intelligence, and apps that can do things in seconds that used to take us days. And that is wonderful. But technology cannot sit across from a client who just lost a spouse and help them figure out what to do next. Technology cannot look someone in the eye and say, "I understand what you are going through, and here is how we are going to get through it together." The human element of this profession is irreplaceable. One of the biggest changes I have witnessed over 50 years is the shift in how financial advisors are compensated and how they are expected to behave. When I started, the commission-based model was the standard. You sold a product, you earned a commission. That was how it worked. But over time, the industry began to recognize that this model created conflicts of interest. If an advisor earns more money by recommending one product over another, whose interest are they really serving? This led to the rise of the fee-only advisory model, where advisors charge a transparent fee for their services rather than earning commissions on the products they sell. It also led to a growing emphasis on fiduciary duty, the legal and ethical obligation to act in the client's best interest at all times. In 2019, the CFP board extended its fiduciary duty requirements, making it clear that anyone holding the CFP designation must put their clients' interests first in every interaction. Lesson number 4: integrity is not optional. It is the foundation of everything. In 50 years, I have seen advisors come and go. The ones who build lasting careers are the ones who do the right thing, even when no one is watching. Clients can sense when you are genuinely looking out for them, and they can sense when you are not. Trust takes years to build and seconds to destroy. This brings me to what I consider the most important part of this profession, the relationships. Financial planning is not just about numbers. It is about people. It is about understanding what someone is trying to achieve in their life and helping them get there. That means listening more than you talk. It means asking questions that go beyond the balance sheet. It means being there for your clients not just when the market is up, but especially when the market is down. There is a piece of advice that I think captures this perfectly. It goes like this: do not focus on making your friends and family your clients. Focus on making your clients your friends and family. When you approach your work that way, everything changes. You are not just managing money. You are building a relationship that can last a lifetime. Lesson number 5. The best financial advisors are the ones who genuinely care about their clients. It sounds simple, but it is the truth. If you prioritize your clients' needs, if you communicate regularly, if you educate them and keep them informed, they will stay with you. And more than that, they will refer their friends and family to you. That is how you build a practice that lasts. Now, I want to talk briefly about credentials because I think they matter more than some people realize. I hold the CFP designation, which is the Certified Financial Planner certification. I am also an enrolled agent, which means I am authorized to represent taxpayers before the Internal Revenue Service. And I earned my MBA from Cal Poly Pomona. Each of these credentials taught me something different. The CFP gave me a comprehensive understanding of financial planning across all areas: investments, insurance, estate planning, tax planning, and retirement. The enrolled agent designation gave me deep expertise in tax matters, and the MBA gave me the business acumen to run a firm and think strategically. Lesson number 6, never stop learning. The financial services industry is constantly evolving. New regulations are introduced. New products are created. New technology emerges. If you are not keeping up, you are falling behind. The best advisors I know are the ones who are still reading, still studying, still attending conferences, and still asking questions, no matter how many years they have been in the business. Over 50 years, I have watched this industry transform from paper ledgers and handshake deals to digital platforms and artificial intelligence. The tools have changed, the speed has changed, the way clients access information has changed. But here is what has not changed. People still need help making sense of their financial lives. They still need someone they can trust. They still need someone who will be honest with them, even when the truth is not what they want to hear. The advisors who thrive over the long term are the ones who embrace change without abandoning their core values. They adopt new technology, but they do not let it replace the personal touch. They stay current with regulations, but they do not lose sight of why those regulations exist: to protect the people we serve. Lesson number 7, adapt to the times, but stay true to your principles. The industry will keep changing. That is a certainty. But if your foundation is built on integrity, on putting clients first, and on a genuine desire to help people, you will be able to navigate whatever comes next. So let me wrap up by summarizing the 7 key lessons from 50 years in financial services. 1. Be willing to learn from the ground up. Education gives you the foundation, but experience gives you the judgment. 2. Markets go up and markets come down. Plan for both. Stay disciplined. 3. Technology is a powerful tool, but it is not a replacement for genuine human connection and good advice. 4. Integrity is not optional. It is the foundation of everything you do. 5. The best advisors are the ones who genuinely care about their clients. Make your clients your friends and family. 6. Never stop learning. The industry evolves every day, and you need to evolve with it. 7. Adapt to the times, but stay true to your principles. These are the lessons that have guided me through more than 5 decades in this industry. They are not complicated, they are not flashy, but they work. And I believe they will continue to work for the next 50 years and beyond. Thank you for joining me on this first episode of the Tellone Perspective. In the next episode, we are going to talk about the value of an MBA and how graduate education can shape your career. I hope you will join me for that conversation. Until then, take care of your finances, take care of your health, and take care of the people around you. This is Dean Tellone. Thank you for listening.